All right, let's just dive right into this explainer. If you look at the digital asset market in 2026, it's basically this massive iceberg. What we see right on the surface is a chaotic, incredibly noisy, highly speculative trading environment. But if we look just beneath the waterline, there are these massive, foundational institutional shifts happening that are quietly restructuring the entire global financial system. Today, we're going to explore both sides of it.
So right on the surface, you've got this retail speculation engine just absolutely firing on all cylinders. In early 2026, the total market capitalization for meme coins like Pepe and Doge surged by over 30%, hitting an insane $47 billion. Seriously, $47 billion for frog and dog tokens? Driven by tax loss harvesting resets and retail investors just rushing back into the market, it's a flashy, super volatile playground that generates a ton of headlines.
But you gotta contrast all that wild retail exuberance with what the heavy hitters are actually doing. Fidelity's May 2026 data shows that while meme coins are blowing up, the major digital assets are actually in this period of consolidation. Bitcoin is hanging out around the mid 70,000 range, down year to date, with Ether and Solana cooling off too. But here's the absolute critical takeaway here. Trading volumes are fundamentally shifting away from spot markets and moving heavily into listed products. The adults have entered the room and the underlying market structure is maturing really, really fast. So here's our roadmap to take us from that speculative surface all the way down into those deep institutional currents. We're going to hit 1. State of the 2026 market. 2. The institutional ETF wave. 3. The corporate treasury revolution. 4. The sovereign accumulation race. 5. The new frontier of Bitcoin yields. And 6. Expanding the Web3 infrastructure. Starting off with Section 1, State of the 2026 market. Chaos versus consolidation. Now, obviously, these assets don't just exist in a vacuum, right? They're super sensitive to global liquidity. And right now, the market is navigating some pretty serious macro headwinds. Based on Intellectilia AI's read, there's over a 54% probability that the Fed hikes rates by December 2026, which almost always pressures risk assets. We're also seeing elevated inflation tied to oil prices, along with some really serious geopolitical tensions. At the exact same time, here in the US, Congress is marking up the Clarity Act. This is a major piece of market structure legislation that could finally clarify regulatory oversight. So it's a very complex environment of tight monetary policy colliding with shifting regulations. Moving into Section 2, the institutional ETF wave, a tale of two assets. All right, moving down the iceberg, we hit our first huge pillar of structural demand. And the sheer velocity of capital here is just staggering. Check this out. Bitcoin ETFs hit $125 billion in assets under management, 20 times faster than gold ETFs did. 20 times. This isn't just a successful product launch, it's a total, fundamental change in how capital flows into digital assets, creating this sustained structural demand that acts as a huge buffer against retail volatility. And the wild thing is, they've barely even scratched the surface. Just think about the $60 trillion wirehouse market. The major global private banks and wealth management platforms. For the longest time, that capital was benched by incredibly strict risk-averse compliance policies. As these platforms start to greenlight access, even a super conservative base case allocation of just 0.5% could drive $300 billion in structural inflows by the end of 2026. For anyone watching the market, this right here is the hidden capital floor being built right under your feet. Next up, Section 3, the corporate treasury revolution, the Bitcoin standard playbook. So taking it a layer deeper, we see this spilling right into the corporate world. Public companies are now actively scooping up digital assets as a strategic treasury reserve. A really massive catalyst for this was the FASB, the Financial Accounting Standards Board, finally changing their rules to let companies hold Bitcoin at fair value. Before that, companies literally faced accounting penalties if the asset's price dropped, but they couldn't report any gains if it went up. With that ridiculous penalty gone, the floodgates essentially opened. Now, high-conviction companies like Metaplanet and GameStop are actively using debt and equity to buy Bitcoin, competing to grow their Bitcoin per share. It's an entirely new corporate playbook designed to hedge against fiat depreciation. Down to Section 4, the sovereign accumulation race, hedging a shifting world order. And this brings us to the absolute deepest currents of them all, actual nation-states and governments buying up digital assets. When inflation hits double digits, trust in fiat starts to erode, and governments naturally start hunting for neutral assets. We are seeing this play out at the absolute highest levels of government right now. In the US, executive action swept roughly 198,000 seized Bitcoin right into a no-sales strategic reserve. On top of that, you've got legislative proposals like Senator Lummis's Bitcoin Act currently being debated, which actually proposes a mandate for the Treasury to buy 1 million Bitcoin over 5 years. Regardless of where you fall on the political spectrum, the sheer scale of these proposals, targeting 5% of the total global supply, is completely rewriting institutional asset allocation models. And hey, this sovereign race is trickling right down to the state level too. You've got states like Arizona and New Hampshire leading the charge with new legislation, and over a dozen others proposing similar bills. The projections here are pretty staggering. Even in a base case scenario where just 30% of these state-level proposals actually pass, that alone could trigger an additional $19.6 billion in capital inflows. We're watching governments fundamentally transition Bitcoin from this tolerated speculative token into a formally recognized strategic reserve asset. Which leads us to Section 5, the new frontier, Bitcoin yield, the $100 billion opportunity. So here's the really crucial point. Once all these big players, institutions, corporations, governments, are holding billions in digital assets, they're not just going to let it sit there gathering digital dust. Enter BTCfi, or Bitcoin Decentralized Finance. Basically, this is the ecosystem that lets you generate native yield, lend, and stake directly on Bitcoin holdings. Institutions are transitioning from just safely holding the asset to actually putting it to work to generate active yield because they're competing to grow their balance sheets faster than everyone else. The potential market size for this is just massive. If you assume even a super conservative 5% utilization rate of Bitcoin's total market cap, BTCfi is a $100 billion opportunity. And with average yields floating around 8%, which totally crushes the fractions of a percent you might see in a traditional savings account, it makes perfect sense why large holders are aggressively looking to route their capital straight into these native yield strategies. Finally, Section 6, expanding the Web3 infrastructure, routing the capital. Now, to support all this immense institutional capital hopping across chains to find yield, the underlying tech infrastructure absolutely has to level up. These big institutions demand privacy, massive scale, and totally seamless routing. That's where zero-knowledge proofs come in. Think of this as a cryptographic magic trick that lets you prove a transaction is perfectly valid without revealing any of the sensitive data behind it. Because for an institution trading hundreds of millions of dollars at a time, privacy isn't some nice-to-have luxury. It's a hard requirement to prevent front-running and market manipulation. This tech literally rewrites the rulebook. We are totally shifting away from the old-school strategy of just passively buying and holding. The new game? It's all about yielding and routing, using some incredibly sophisticated cross-chain infrastructure. Institutions are starting to treat blockchains not just as ledgers to record who owns what, but as the actual foundation for how they move capital around the globe. And we're actually watching this play out in real time. Back in April 2026, SOL Strategies, a publicly traded company heavily invested in the Solana ecosystem, announced this $18 million acquisition of Houdini Swap, which is a privacy-focused cross-chain aggregator. They also scooped up Dark Lake Labs, specifically for their zero-knowledge proof tech. Why make a move like that? Because Houdini Swap had already processed $2.5 billion in transaction volume. That right there proves the immediate, massive institutional demand for routing capital securely and privately at scale across over 100 different blockchain networks. To pull this whole thing together, there's a quote from UTXO management that perfectly nails the core thesis of our explainer today. They essentially pointed out that Bitcoin is transitioning from a speculative asset to a strategic imperative. The market has fundamentally shifted. The days where digital assets were just a retail playground for meme coins, those days are over. We've entered a completely new era defined by sovereign accumulation, massive corporate treasuries, and ultra-advanced institutional infrastructure. Which leaves us with one final, kind of provocative question at Shuan. If the massive wirehouses, the Fortune 500 companies, and actual nation-states are all aggressively racing to gobble up and route a mathematically fixed supply of digital assets, what exactly happens to the everyday retail investor? Are they going to be completely priced out of the very financial revolution they helped kick off in the first place? Thank you so much for joining me for this explainer. I really encourage you to dig into these sources yourself, and I'll see you next time.